Welcome to this week's episode of the Chant. This week I'm talking to my buddy Jeff Meyers. He's a portfolio manager and financial planner. And that's what we talk about today. We talk about finance, specifically retirement accounts. We talk about 401ks, IRAs, how to kind of navigate this world. We stress how important it is that you do save for retirement and that you probably need to be saving more than you think you do. This is a great chat. We talked for an hour and a half and we just kind of barely scratched the surface. So don't be surprised if we see Jeff come back again to break down a different part of personal finance. I'm also very tempted to work with Jeff to create maybe a series on personal finance with shorter videos, maybe doing 20, 30-minute videos where we talk about one specific part of finance and get into it in depth so that you know what to do in your own personal life and can get things set up and just be financially healthy. That's an important role for everybody, but specifically I would say fathers and husbands, and that's kind of our target audience. So if that's something you're interested in, leave a comment below and let me know, or reach out to me anywhere you can find me. I'm really like that idea and I think it would really help out a lot of guys. Anyways, enjoy my chat with Jeff about how to save for retirement. Your house.
And he's a bit of a clean freak too. He likes organization.
Yeah.
And then to live with people like Doug and Jake who don't care, and Ish who didn't care.
Yeah. And I just
well,
remember,
Ish cared.
Ish cared.
Yeah.
I just remember I was sleeping on the couch one night there, and I could hear the rats in the ceiling running back and forth. These little scamper, little shuffle. And I just remember going like, I hate this. I hate this so much.
You just don't sleep because you're like, I hate this.
I'm just like all mad at the rats on the ceiling.
Oh my gosh, that's wild.
Yeah, the scampering across the ceiling was brutal.
As you say that, my dog is running around upstairs as my wife is leaving.
How long have you been doing financial stuff?
Since graduation.
Were you like a business major? I don't even remember.
Financial management.
That was a major at Hillsdale College? You went to Hillsdale College and you got a financial management degree?
So, yeah, I know. It's got a good story, but I don't think I'm proud of that major.
What, like, I'm
just proud of the fact that I went to Hillsdale.
That's great. Yeah, I just think that's like...
It's wild, yeah.
That's wild. It's an interesting, like... It's a business degree. Is a Hillsdale business degree that much better than like a big state school's business degree?
In terms of what you learn business related? No. I would argue that I didn't learn anything about finance from my major.
Well, I would argue that most degrees in general don't teach you anything about what you're actually going to do for work, but
right.
Interesting.
Yeah.
Why did you major in that and not like a real Hillsdale major?
So I came in wanting to double in English and history.
There we go. See, okay, so you came with the right intention.
That's right.
Okay.
That's right.
Yeah. And to be clear, as an economics major, I took a hard time for not majoring in a real Hillsdale major. And I was like, this is economics. Like, it's close.
It's really close. Yeah. Especially really for Hillsdale.
Close. Yeah. Especially like Hillsdale has a very unique economics program. It's like, why aren't you into history or politics or philosophy? It's like, I don't like to read that much. Yeah.
So I like to read, and I was super excited about. I loved my history classes and my English classes, but I decided, or I thought, because Derek got me into CrossFit freshman year.
You still do CrossFit?
No.
Oh, you quit the CrossFit, huh?
Yeah, I just don't pay for it anymore. I just kind of do my own thing at the house, basically.
Okay.
Yeah.
I'm sad. That's...
Well, so the thing that I pursued at Hillsdale a lot was work more than class.
That's true. I remember
you always
had side jobs. So I guess they're like real jobs, I feel like you were always wearing khaki pants and like a polo shirt because you were doing stuff.
Yeah, I worked a lot of jobs. But one of the first ones was security at the gym for like a semester.
I remember that one.
Yeah. And so Derek got me into CrossFit, and then I got into like personal training, and I got the job at the end of freshman year to be the director of men's residence life and campus health and rec.
Okay.
So I like did the triathlon and managed the budget for Simpson Dorm. Managed the budget. Hey, you guys have $500 to spend this year. What do you want to spend it on?
See, it's already starting. All the portfolio management started early.
Exactly.
Yeah.
It's all there. And so I called my dad like in the spring of freshman year and I was like, "Hey, I want to be an exercise science major because I
Sure.
really like this fitness stuff." And he
Yeah.
was like, "You don't go to Hillsdale to
Yeah.
get an exercise science degree. If you really want to do that, I'll send you somewhere else that's a lot cheaper."
He
And
ain't
I
wrong.
was like, "Oh boy."
Yeah.
Yeah, so then I had to think about that for a minute and I went through this dilemma where I was like, "Okay, so do I want to pursue a major in something like history and English, or do I want to find a major that's going to like move me into the direction of a job? Like, what do I want to do with my life?" So I like talked to so my wife was my girlfriend at the time. She was my high school sweetheart. I called her dad and I was like, "Hey, what do I do with my life?" He was like,
Right.
"You should be a doctor." And I was like,
There we go.
"Oh, should I be a doctor? Maybe I should be a doctor."
Right.
And then no,
No.
no.
No?
But I went through like a 2-week dilemma, and I was in Dr. Connor's office
Okay.
for 6 hours over the course of 1 week, like different meetings with him, of like having this midlife freshman year crisis of
Wow.
what do I want to do with my life. And in the middle of all that, my uncle helped me get an internship at a law firm here in St. Louis.
Okay.
So I went. So after I left school, I was like, whatever. I don't know what I'm gonna do. I'm just gonna go work for the summer and see like what comes of it basically.
Sure.
Really loved law. Thought that that was what I really wanted to do. I was given a lot of really cool experience and opportunity as an intern. Like I got to go to depositions, take notes, like write debriefs for attorneys and stuff, and like prep cases, go to court. It was really interesting. And one attorney that I worked with really closely kind of took me under her wing and she's like, "What do you want to do with your life?" And I was like, "I think maybe I want to go to law school now." She's like,
Yeah.
Don't do it. Don't do it." And I was like, "What?" She was like, "Find something else to do. It's not worth your time. Like you won't enjoy it and it's going to put you in like
Yeah.
one hole and you don't want that for the rest of your life." And I was like, "Okay, so what do I want to do then?"
So you bounced from history and English to physical kinesiology type of a thing to doctor to now lawyer. I think you hit
It
them
gets
all.
better. It gets better.
Is astronaut coming? I hope.
Is the astronaut coming? No, no.
Okay.
Thankfully, there's no astronaut.
Okay.
That's a common theme, though, for me. I like a lot of things, and I pursue a lot of interests.
Sure.
Um, well, so then the other thing, when I was there, I noticed something called an estate planning attorney. One of the partners, I remember he had a corner office, and I
Yeah.
was like, "What are these other letters after his name?" He had a CPA, and I was like,
Okay.
"What does that even mean?"
Right.
So once I figured out what accounting was and the things that he was doing with his law degree, I was like, "Ooh, I think I like numbers. That could be fun."
Okay.
So I talked to him about it, and he told me to do a business degree and go into accounting. So I signed up for Accounting 101 sophomore year,
Uh,
and I had a little bit of space in my schedule. I was like, I'll just take it light and see what happens. And I took I think 2 classes of accounting, and I was like, "Ooh, I hate this. This is terrible."
doesn't help that I forget the professor's name, but he was not
I,
ideal.
I can't remember his name either.
He was. I remember he was like Hawaiian.
Yep. And he always said that he got banned from all um, casinos because he was caught counting cards or something
Yeah,
like
and
that.
he was on Jeopardy.
Yep.
And I remember one time there was a party, and like it was like the econ club hosted a party, and they invited a bunch of professors, and he drank a lot.
Yeah.
That's what I remember. I couldn't tell you his name though.
I can't remember his name
And
either.
I remember at graduation when I like I get the diploma and you step down. He was there to like give me a hug and handshake. But I didn't. I had like one class with him, and I got like a B minus. I remember he was there. I remember
Yeah.
he was really happy for me. I think he confused me with somebody else or something.
You probably did. I don't. He never had any idea who I was.
Anyways, I remember that. That was hilarious.
Yeah. Well, so I took that class and I was like, this sucks. But I've got room, and there's this class called Financial Management with Dr. Basterfield. I'll give that a shot.
Sure.
He hated me. He still to this day thinks that I have no idea how to do Excel, and Excel is like the main part of my job. It's so funny. But I took his class and I was like, okay, present value investments, that stuff's cool. I like this.
Oh, really?
Yeah. And so then I basically just got hooked on watching the market and getting into those types of things, and taking those classes, and kind of I was like, this is what I want to do. The other thing too for me, that summer working at the law firm, my girlfriend at the time, my wife, she was like, I was kind of like thinking like, is this going to be a long-term thing? Are we actually going to do this? We've been together for 3 years. Like, so I actually spent a lot of time praying that summer, and I made like $10 an hour, I think, as an intern. That was the most money I'd ever made in my life. And as I made that money, like I kept thinking like, what do I want to do with this money that I'm making? And like the theme that kept coming back to my head as the more I prayed about it was like, I want this for my future wife, and I want this for my family. And oh my gosh, that's Katie. Like that's exactly what I want to do. And so I like that summer, I went and visited her at the end of the summer, like made a commitment to her. I was like, look, I'm going to graduate college early. We're going to get married. This is like, I'll make you a promise right now, and I'll propose to you next year, basically.
Okay.
So that kind of solidified everything in terms
That's
of
nice.
like life track.
Please get that part figured out.
Yeah.
Yeah.
Then I could focus on other things.
Yeah. Nice. Okay, so that's where you got like the itch for the markets.
Yep.
Did you start investing like your own money right after that?
Yeah.
How'd that go?
Terrible. I remember in my investments class, we were all like in charge of a portfolio, and we
Sure.
had to take a theme and invest according to it. And for some reason, my theme on my group was Russia. I
I
don't
thought,
know.
why? How is that a theme? I thought the theme would be like, I don't even know, like investment strategies. Why would the theme be a country?
No, it was like sector based,
Okay.
kind of focus. So like it was more of like frontier markets,
Right. Like emerging,
Russia related,
yeah.
kind of, but
Energy.
not really.
Yes. They're an energy thing.
I think so. I honestly don't remember what we even invested in, because there
Okay.
was one guy in my class who was way smarter than me, and he did the whole group project.
Nice. That's how they go.
So
That's how they go.
yeah, but I remember distinctly that one group got mega lucky. Like they chose some random railroad stock that had some sort of either Warren Buffett invested in it, or
Okay.
it hit some sort of like explosive growth, and it went from like $1 a share to $10 a share.
Oh, nice.
And they like freaked out, thought they were the smartest group on earth.
All
And
right.
me not knowing anything, I was like, these guys are smart. I'm buying this.
Oh, no.
So I had like a little Roth account and I spent all $100 and bought that stock, and it went straight down.
Straight down. Warren
But
Buffett probably pumped and dumped it right there. Yeah.
yeah, he got me good that time. But
Yeah.
I was like, I would like pull out my phone in class, check the stock price, be like, dang it.
That's it. It's down 50 cents. Come on. Come on, market watch.
That was pretty funny. That was fun though. Yeah.
That's great. And so then graduated with a business degree. Right now you're a portfolio manager. So like, what is that? That's not an entry level job, right? I don't think I don't think like right out of college, like, yeah,
No.
here, manage the portfolio. Like, how do you get to that portfolio management level? Like, how do you get there?
It's different because portfolio manager is kind of a misnomer.
Okay.
I mean, most of the time you hear the term portfolio manager, and what you think of and what you hear on like or see on Twitter or CNBC or something is like, the guy that runs the Vanguard fund,
Right.
whatever, Vanguard Total Stock Market. He's a portfolio manager. That's the normal kind of, he's the one out picking, well, they're indexing. So he's the one keeping the portfolio aligned to the index. He's working with analysts under him. Mine is more of like what the title is what I actually do. So like managing people's portfolios,
Okay.
instead of like a mutual fund or something.
Sure.
And it's more akin to like a trading specialist type of role.
Sure.
where I work with a bunch of different financial advisors who give the advice and have the conversations with clients, and I just invest the money basically.
Okay. So you're working within the trading platforms and like putting out the different buy, sell orders, all that stuff.
Yep. Yeah. So there's, I don't know, like I think a little over 1,000 portfolios on my desk that I
Okay.
monitor every day for daily needs, like if someone needs cash or they added money and it needs to be invested or they need to rebalance their portfolio or something like that. I've got screens up and watching it all day, basically, kind of stuff.
So do you have the 8 monitor setup? One of them's got the chart. One of them's got, oh, I don't know, the news that you're watching Bloomberg over here. Do you have a Bloomberg terminal?
No, I don't. I'm
You don't
not
have.
that cool.
I was gonna say
Yeah.
they're like 150 grand, aren't they? Like they're ridiculous.
Yeah. Like per person
Oh yeah,
at a firm.
per
Yeah.
terminal. Yeah, it's
Uh-huh.
disgusting how much those things cost.
I know. I love it.
One day you'll get one. You'll get your terminal.
I hope so. That'd be
Yeah.
awesome.
Okay.
So I have 5 screens.
Okay. 5.
Yeah.
And
Yeah.
each one you have a different purpose for. And what's the like? How do I want to put this? Investing news is stupid, right?
hmm
Okay. I just want to like, what's
Yeah.
the one? What's the channel that's got Kramer on it? That's
I think it's CNN, CNBC, one of
C.
those.
It's one. It's C. Whatever. The financial NBC, I think, is the one it is, right?
Yeah. Yeah.
Yeah.
He
So,
just screams the whole time.
well, that's fun. I like that. Uh, but like, so I think that's an interesting like people who are getting into investing. They're like their first thought is like, well, I'll change the channel. I'll start watching this more.
hmm
But I think, from what I understand of investing, is that that's for suckers.
Yeah.
Can you kind of like go into that? Like, why is that so bad? Like, I don't. Why don't they
Uh,
just want to help you? Why is the mass media behind the financial markets? Why don't they just want to help the retail?
because everyone is inherently selfish.
Okay, go on.
Man is inherently bad. There's a great book called The Intelligent Investor
Okay,
by Benjamin Graham, who was Warren Buffett's mentor.
okay.
And so the way that he talks about the market is he calls it Mr. Market. And so he said, imagine you have a friend, his name is Mr. Market.
Mhm.
And back then when he wrote the book in 1930s, you got your stock news from the newspaper.
Right.
So he says every morning he calls you and tells you the price of your stock. And every night he calls you and tells you what the closing price was. And
Mhm.
so he's going to do that every single day, no matter what. And none of that matters because the intelligent investor is looking at the business and what the cash flow is being generated from the company. They don't care what the price of the stock is.
Mhm.
And so these news cycles and the talking heads that you see all day long, they're just screaming about price.
Right.
Well, the price jumped 1% today, or it's down 30 basis points today. Like, how does that actually impact you? Well, it doesn't. Um, Unless you're like a day trader and you're jumping in and out of a position in the same day.
Right.
But most of us, people who are saving for retirement, saving for, a long-term goal, the daily price fluctuation shouldn't affect you in any way at all because
Right.
you're a long-term investor. So you care about over the long term how your position grows, basically.
Okay. So let's talk about like long-term investing. I know that
Yeah.
there's that's probably like the most to me one of the saddest things I can think of is like getting to that like 65, 70 age and then just like not having a savings, not being able to retire, not having any sort of account, not like that's when the medical bills come too. So it's like not
Yeah.
any like that's just a really scary scenario and like a real it's a very real scenario. Like it happens to a lot of people, I have to imagine. So
Yeah.
like I think that like making sure that when you're in your 20s and 30s, having something there, even if it's something that can just pay for the medical bills, will save you so much. So like
Yeah.
are like what are like the like what are the basic like investment, I'm going to use the term vehicles, and
Yeah.
I don't know if that's correct,
Yeah.
that like people should be looking at early on just to like make sure that they're not completely like screwed when they're older.
Yeah. So the first thing is the average size of a 401k for people in their 50s right now, or at least last time I read, which was maybe a year ago on the fact, is $94,000. $94,000 will not pay for anything that you need. If you are without a job and all you have to your name is $94,000,
That's yeah.
that's
I mean,
not good.
that's not good at all. That's like like what, like 2 years maybe you got on there.
Depending on how much you spend a year, right?
Right, and that doesn't even include like maybe you have a housing payment, maybe you have medical bills. Like what are you going to do with insurance? What are you going to do?
Yep.
Let alone all the other things that so that's not good.
Yeah, it's terrifying, and to be in that situation, I like, as a 27-year-old, it scares me to think about being in that situation. And it's
Yeah,
like 30 years away.
right.
But it's very, very real. And I've met a lot of people and worked with a lot of people over the years that are in that situation exactly, and they have no choice but to keep working.
I was about
And
to say, like,
some of
what
them
do they do?
can't.
Is it just
The-
pick up a
I
minimum
mean,
job or something and keep going, or like what?
that's an option at minimum wage. They keep working at their job and they kind of get pushed to the side and they don't get promotions, or they
Right.
try to get a new job and the new job doesn't really do a lot to
Yeah.
give them, but most of them end up like, you've seen them, like Walmart greeters,
Let's
because
say like
that's all they can get.
yeah, every time I see like a very old like cashier or kind of one of these, I'm always my suspicion is like you didn't save. You didn't maybe you couldn't save. I don't
Right.
know. But like
Yeah,
that
and yeah, you got to be careful because you can't just assume that people
right,
just spent all their money and they may not have learned anything about it. And
right. I mean,
unfortunately, most people don't.
yeah, and I'm not like assigning blame. I just know it's a sad situation.
Yeah, absolutely.
Yes.
Yeah.
Yeah.
So there are a couple different vehicles to choose from. I mean, the most basic one that everyone should kind of be aware of and at least putting something towards is your 401k plan. Um,
But okay, so but not every company offers a 401k. Is there
Correct.
can we go more basic than 401k and then get into kind of those? 'Cause I guess I'm trying to steer us towards IRAs because I think
Yep. Yep.
that's the one everyone has access to, right?
Yeah, exactly. You can set up a traditional IRA and a Roth IRA.
Okay.
You can go online to Schwab and set it up in 5 minutes. Yeah.
Which one should people go for? Like, can you explain the difference between the two and maybe kind of
Yep.
maybe not tell which one they should go to, but kind of lay out the pros and cons of each?
Yeah. So the way that we think about it and the way that we kind of um, the way that we describe them is tax advantaged versus tax free.
Okay.
So a traditional IRA is tax advantaged, and that means, and there are rules around this too, so you have to be careful. It's not like a blanket statement, but most of the time, the money you put into a traditional IRA can be tax deductible. So when you fill out your tax returns at the end of the year, you can say, hey, I contributed $5,000. That can be a deduction from your income
Okay.
on your tax return. There are rules around it. If you have a 401k, you can't make a tax deductible contribution. If you make a certain amount of money, you can't make certain contributions. But the way that works is you take your own money from your savings account, put it in an IRA, and then you'll get a statement at the end of the year and you fill in on your taxes that you made a deductible contribution. Now, the
Okay.
difference between the traditional and the Roth is the Roth is considered a tax-free entity. And the reason is that you put in your own money, you don't get any deduction for it, but it grows tax-free. And when you withdraw it, based on certain parameters and rules, you have to be over the age of 59 and a half, and the account has to be open for at least 5 years. The money that comes out of it is tax-free. No capital gains tax, no ordinary income tax associated with that. The
So
difference,
yeah, so it seems like the idea is like you've already paid taxes on that money, so you don't need to pay them again. Is that kind of the basic logic on it of it?
yeah, exactly. And so the way that that works in the opposite end with the traditional IRA is you put money into it, you get a deduction for it. When you pull that money out, it's taxed at ordinary income rates.
Oh, interesting. So it's not
Yeah,
tax debt. It would be capital gains.
correct.
And
It would
capital
not be capital gains.
yeah, and capital gains is usually lower than income tax, right?
Yep. Yeah, exactly. There's three tiers of capital gains tax rates: 0, 15, and 20, I think,
Right.
depending on long-term, short-term, and then the amount of money that you make. So it's
Sure.
way more tax advantageous. So if you open what's considered a brokerage account or a taxable account, an
Okay.
account that's just in your own name, it's not tax advantaged. You put money into it, it grows, but as you make sales and buys within that account every year, you
Yeah.
get a tax statement at the end of the year. So you'll have to pay capital gains taxes if you made a gain through the year, or if you just buy something and hold on to it forever, you don't have to pay taxes until you sell that position.
Okay, that's good to know. And I think this is how I learned. This is how I know about capital gains taxes. Is that I remember 2012 election, Mitt Romney up against Barack Obama, and they showed how much each paid in taxes.
Yeah.
Barack Obama paid like whatever 45% because they showed his income tax, and then Mitt Romney, being a rich dude who was just making his money off of investments, was getting charged like 15%. And they're like, "See, the rich keep getting richer." And I was like, "Those are different. Those are different streams of income. Like they're different. They would have been taxed probably the same had you just been looking at income or like income versus like Barack Obama was making the exact same, was taxed the exact same amount on his investments." But that's my funny. No, I don't know if it's funny, but that's my capital gains. Like
That's how you remember it.
That's how they got Mitt Romney. Yeah. Okay. So what? Aren't there's like contribution limits? Why do they not want me to put more money in?
Because the government wants to tax you. They want their money now.
Yeah.
So currently I believe the contribution limit is 5,000, might be 6,000. So once you reach a certain age, your contribution limit goes up 5,000. So pretty sure it's 5,000 right now, like for you and I, but then my parents can contribute 6,000, and it goes up a little bit every year, just like your 401k max contribution goes up a little bit each year. But there are also limits. So if you make a certain amount of income, you can't deduct your IRA contributions. And if you make even more, you can't even make a Roth contribution.
Right. Okay.
Yeah. So the key with that is because the Roth is tax-free growth, ideally every kid, teenager, college student, young adult working should have a Roth IRA and start funding it, even if it's $100 a month.
And
because theoretically you're going to work hard enough to get to the point where you can't do that anymore.
Okay.
And with the power of compounding,
let's talk about that, because every investing like person talks about compounding.
Yeah.
And it's it's the whole thing, like you make whatever 8% a year, and over 50 years it's $1 million, right? Always comes to $1 million. And every example, $1 million, and it's like,
put a penny in, it's $1 million.
You're gonna be a millionaire when you retire. And it's like, okay, fine. But like I've always like, if you just did like a Roth IRA, and you let's say you just maxed it out every year at 5,000 at that 8% compounding, is that enough to retire with? I know I'm asking you to do semi-complicated math off the top of your head, but do you know? Can you do that real quick?
Is it enough to retire? I don't think so.
Okay.
But let me do a little present value on my on my glorious Excel spreadsheet right here.
Right.
What do we think? Like 50 years of contributing, or 30, 20?
Let's do 30. Let's do like a semi worst case scenario. Like say you're 30 and you're just started investing. 30 years, and you're contributing $5,000 a year every year at, we'll say, what, 8% investment? Isn't that the market average?
Yeah, it's 7%, but
7. All right.
It's good.
It'll get us in the ballpark.
Yeah. So the other thing too that changes about this. Whoa, I hate present value sometimes because it never does what I want it to do.
I know that's why I wanted you to do it, because
I wanted you to do it.
because the whole 5,000 every year complicates the math. If it was just a one-time contribution and then 8% growth every year, I can do that no problem.
Oh sure, yeah.
But once you start doing 5,000 every year, like this makes the math tricky, and I don't remember how to do it.
Actually, I built a like, we have all of these systems and software at my firm to do all these things.
Yeah.
And I still love to just do it in Excel. So I actually built my parents a like a financial plan.
Oh, nice.
And like did it all in Excel and everything. And it was a lot of fun. Okay, so let's see. Oh yeah, we got to change the retirement year. What's today? 21?
Yeah.
51. Yeah. So if you are contributing $6,000 a year,
Okay.
8% growth, and we're doing it on a monthly basis,
Sure.
at the end of 30 years, that's like $400,000.
Okay.
Is
That's
that enough to retire on? No.
no. What is
No.
enough? Is it $1 million?
So this is the easiest way to think about it. It's called the endowment method.
Okay.
It's the way that endowment funds fund their organizations because they have super large,
Right.
couple $1 billion portfolios. And the endowment method basically says that you are going to invest less than your account will grow. You'll spend less than it grows, but that number always comes out to be like 4 or 5%.
Sure.
So if you think about you're making 7% a year and you're going to spend 4% a year, that gives you 3% growth while you're still in the withdrawal stage.
Right. So
But
that
if
you're making that 3% off of that lump sum you've accumulated. That
right,
in this case, that $400,000.
yeah, exactly. And theoretically, you're only spending what you're making that year, not touching the corpus
Right.
of your investment. But if you think about you have $1 million, 4% of that's 40 grand a year.
Right.
So can you live on 40 grand a year? Some
Tight.
people can. It's
Yeah.
tight, exactly, especially nowadays and depending on where you live. If you live
Right.
in New York, it's
Depends on
probably a
the
lot more than Missouri.
yes.
So what I've seen is, people who are killing it with $1 million in the bank and people who are barely making it with 5 million in the bank.
Right.
So it really depends on your situation and kind of your standard of living and
Right.
where you want to, like, do you want to retire in Palm Springs and have the big fancy house and the 4
Right.
golf carts and the Mustang outside, or do you
Yes.
want to retire in a living with your kids, next door taking care of you kind of stuff?
Right. I think that's a good point. But that is interesting that like I do forget when I think about retirement. It's like it's not just a lump sum and then you eat chunks out of it. Like it still grows,
Yep.
which does make it last a little longer. But like you're talking about with that $1 million, 4% is 40K a year. Say you spend 50K a year. Well then, now it's negative and now your return now it's not. So it does shrink on you, although it
Right.
doesn't shrink as fast as just eating out of it. So but that is
Right.
I think that okay, so I kind of set you up because I knew uh just maxing out your IRA and like 7% interest wasn't going to be enough for retirement because I want like because I've done the math before and that's when I got scared.
Yeah. Yeah.
That's when I was like, oh, like retirement's super important. Because you can't just be like, I'll just max it out and I'll be fine. Because it sounds good when you hear like,
Right.
I'm maxing it out. I'm maxing out the account I'm supposed to max out, the IRA, and I will be fine. And the answer is, unless you started at 15, you probably won't be fine.
Right. And I don't
So,
think you can open an IRA at 15. I think you have
no,
to be
but your dad
21.
can open it for you because that's what my dad did. Uh,
Nice.
yeah. Uh, so yeah, I think that's like 5 grand a year. That's a chunk of change. That's
Yeah.
like that's not an easy thing to save for a lot of people. For most people, I'd argue.
Right. Right.
So it's saving for retirement is hard.
Mm-hmm.
I think that's if anybody who watches this, all 30 of them can take away one thing is that saving for retirement is super hard and it's gonna like it's gonna hurt in the short term. Like it
Yep.
almost has to, right?
Yeah, exactly. Yeah. It's just it's a discipline and that whole idea of foregoing um near-term gratitude for long-term survival, honestly.
Yeah, that's a good point. And that doesn't even include like all the other things that like we want in our lives. Like we want to pay for our kids like college and all that other kind of stuff. And
Yeah.
that's gonna hurt too. But like,
Yep.
5 grand a year doesn't cut it.
Right. Right.
Six grand a year doesn't even cut it. So like
Mm-mm.
I think that's worth keeping in mind because
Yeah.
that's a used car right there. That's it. You could get a new used car every year for 6 grand, minus 6 grand, and it wouldn't be enough. So
You'd
okay,
have a
so
lot of cars though.
you would have a lot of used cars, but they would also depreciate in value, and so not even a good investment there.
Terrible investment.
Yeah. Okay, so Roth IRA. So you recommend everyone just blanket statement contribute to your Roth IRA at the very minimum.
Yep. Yep.
So going into so as I understand retirement accounts, and tell me if I'm wrong here,
Mm-hmm.
or if there's something I'm missing. Is it like IRA? Like that's is that is that a government vehicle? Like it's available to everybody. Like you can go to like any
Yeah. Any
utility,
place.
open one up real quick, and they'll just give
Yep.
you one.
Yeah. I think you can probably even open an IRA with Robinhood. I think.
Okay, I know you can with the one I use is Wealthfront.
Yeah.
They had some deal and I snagged it. They have some good stuff. So that's
Yeah.
just kind of the basic one anyone can open. As I understand it, like next tier up is your 401k and your 403b.
Mm-hmm.
So can you kind of go into those a little bit and like what are those better? Is one worth prioritizing over others? What are kind of some of the rules around that?
Yeah, so those are what's called a defined contribution plan.
Okay.
So employer sponsored retirement plans where you have the ability to contribute through a paycheck deferral program, right? So they automatically deduct that money from your paycheck. So you don't actually have to, deal with the mental and behavioral pain of, oh my gosh, $6,000 is coming out of my bank account, going into this savings account that I can't touch. It's out of sight, out of mind. They just pull it for you. Um, the 401k and the 403b are the same vehicle. They're just allowed for different companies.
Okay.
So 403bs are only allowed for nonprofit entities.
Okay.
There are a few different rules around those. Like there's no rollovers. You can't do an in-service rollover. You can't take advantage of that funds until you actually leave that job.
Okay.
401k is a little bit more leniency, but it's the general company plan. And then there's something on top of that for smaller companies called a simple IRA,
Okay.
which is similar to, like, it's a mix between the IRA and the 401k. Again, different rules, but larger contribution limits. And that's the biggest thing with the 401ks. You
Okay.
can contribute more. So right now, the max contribution you can do per year into a 401k is $19,500.
Okay.
So it's a lot more. And that money is the same as the IRA. So it's tax deduction, but it comes out of your paycheck. So the company takes care of all that for you for your taxes, right?
Okay.
And then when you retire or leave that job, you can roll it into an IRA, and
Okay.
then you can start taking from that if you need distributions, and that those distributions are taxed at ordinary income rates.
So that's interesting. So does that mean uh can you, like, say you hit retirement, like say keep the scenario simple, you've only worked one job your whole life,
Yep.
you're a factory worker, it's 401k, you've been contributing to it, then you retire. Would you have to roll that over into an IRA before you could start withdrawing funds? No?
No, you don't have to. So the thing with 401ks is, because they're company sponsored, and I mean it's a benefit for both the employer and the employee.
Okay.
So they make it very simple so that it's very easy for people to sign up and do this.
Right.
That's why you also have a lot of companies have a match program.
Right.
So the employer will say, hey, if you contribute 3%, we'll match 3%.
Right.
So really what they're doing is they're incentivizing you to plan for your retirement, because so many people don't. It's also a tax deduction for them, so they really want to do that as well.
Yeah.
Everyone gets their own back scratched, right?
Yeah, that's how it goes.
But with that, they want to make it as easy as possible, so they limit the number of investment choices you have.
Mhm.
You usually have a basic automatic kind of, if you don't want to choose, they'll automatically put it into what's called like a balanced portfolio. So 60% equities, 40% bonds,
I feel like
and
there's usually
say,
like a slider where you just pick like risky, less risky, and
yeah, right.
slide it, and you're just kind of like, all right, whatever. Like,
Right. Or you can be like me and be like, I want 0.15% in this fund, and
oh, nice.
go
Right.
really nerdy into the whole thing.
Yeah.
Yeah, so they try to make it as simple as possible. But with that, you generally have between 15 and 30 investment choices
Okay.
in your 401k plan. And when you do that, you're paying fund fees,
Right.
plan administration fees,
Right.
and so those can often be rather high. So
Sure.
really, when you retire, it is more beneficial to you to roll it into an IRA, because whether or not you're an investment professional or working with an investment professional, you can choose the funds that go in there.
Okay.
So you could roll it out of your 401k plan where you're paying 1.25 into some Vanguard fund that you're paying 8 basis points, and
Sure.
then you're saving on taxes right there, or on expenses right there. You don't have to do that to take distributions, although it's going to be a lot more challenging to, like, you have to go through your plan sponsor to get access to those funds.
Right.
So if you've got to call your prior company, say, hey, I need a distribution, they're not really super inclined to do that.
Okay.
They would rather you just get it off their books since you're no longer an asset to their company.
Right. Okay. But they both are taxed the same way when you withdraw funds from them.
Yep.
That's interesting. I didn't know that because I had an old 401k that I rolled over to a IRA,
Mm-hmm.
and I was like, I don't, I'm just, I knew that was the thing to do, but I was like, who knows how screwed over I'm going to be when whatever. But that's good to know that like
Yeah.
essentially they operate similarly, at least from like a shallow understanding of it as the consumer, whatever I am relative to the IRA.
Yeah.
That's good to know. And then, so here's a question that's very like millennial based because it's one I have, and I realized I don't know the answer to this question. I finally have someone who can answer this question for me.
Nice.
So it's great. But like, no, it is because our generation like jumps between jobs a lot. So I have 401ks with like several different companies.
Yeah.
What is the goal should it be like consolidate each one into a regular IRA after each subsequent hop? Is that the trick?
Yeah. In my opinion, and that's what I've done because I've hopped a few jobs as well.
Okay.
And I pretty quickly after leaving, I grabbed my 401k and pulled it out.
Okay.
Because just the access alone to be able to see it, you don't have to log into the
Right.
HR website or whatever their thing is. They're not going to boot you off it, because what you're doing is you're logging into someplace like Schwab or
Yeah.
Wealthfront or whatever to get access to it. And consolidation is huge because if you go 5 or 6 years and forget about that account,
Yeah.
it's money you don't have any way of getting access to unless you remember that because they're not going to reach out to you other than like annual
Right.
statements.
Right. They would love for you to forget about that count, probably. Like
Yep.
that's just free money for them to invest with.
Well,
And
not that they're gonna take. They can't take it from
no, but
you.
like if it goes into their pool, right? Like they're not just taking like your little bit and investing that
Yeah.
little bit. Like they merge it all together and it's part of the pool and they can probably take fees from it, I would imagine as well.
Yeah. Yep. Yep.
So it's just money that no one cares about. They can just kind of trade and no one cares and just pick out whatever 1% here, little trading fees along the way.
Yeah. It's super common for people, even in other generations, to leave their 401k because they're either afraid of managing it themselves or they think that the 401k administrator is going to do a better job for it.
Right.
And that is unfortunate because it's just not, like you said, they just don't care about you.
Right.
So it's
And
really
they can,
hard.
and like I also think it just makes sense from a organizational standpoint. Like I've yet to come across a 401k like website or portal that's easy to use, and it's always like I have to get the link from my HR manager and and then from there I log in, and then from there, and it's like if
Yeah.
you no longer have contact with that HR manager, then you got to do your password recovery, but then maybe it's tied to your work email. That's
Yep. You don't
and
have access to that work email anymore.
right, and like I'm sure legally you have the rights to that money, and you could get to it if you made a big enough fuss. But like,
It's just not easy.
it's just not, and they're not going to make it easy, right?
No.
So,
And nobody likes to do this kind of stuff with their finances anyway. So you throw up one small wall that you have to hop over and everyone's going to quit.
right. Like finances are already intimidating to a lot of people. You
Hmm.
throw in a complex password that they forgot, they'll be like, "I'll do it next week," and then 50 years go by, and there's whatever 30 grand they forgot about. So, yeah, I think that's a really important. Okay, that's good to know. That's what I should be doing. Is
Yeah.
rolling. That's what I thought I should be doing, but because I just think like finance it's slimy, right? Like it's
Yeah.
there people will screw you over. Like they got no problem with it. Like and like tangent. Okay, I'm just going to announce the tangent because this is something that bothers me is that I personally don't think retirement accounts should even exist.
Okay.
Okay, because if we had interest rates at banks like we did 60 years ago in like the 6 to 8% range, like what was once normal, there would be no need for a retirement account
Yep.
because you could just put your money in a bank and be done.
Yep. Let
It
it sit
is,
there forever. Yeah.
and it is personally my opinion that the financial people at Goldman Sachs and others like intentionally lowered interest rates so that people would have to put their money into the market and they could take more money out of it in terms of like, fees and stuff.
That's so funny. Conspiracy theory.
It is a conspiracy theory, but like I'm not wrong. The financial industry is booming, and it wouldn't be booming as much if everyone had their savings accounts in banks
Yep.
like they should,
Yeah.
making 6 to 8% interest, like in a normal, healthy banking world.
Yeah.
And
It's definitely a slimy industry, and I've met plenty of people that are just the moment you meet them, you're like, ugh, get away from me. Like I don't, and the fact that I have to be associated with them is often very frustrating.
I
But
can imagine. How is that like? Let's get into like as a Christian.
yeah,
'Cause I talk with Clint. He's in law, another slimy field.
yep,
He had some issues with it. How are you dealing with it? Like, obviously, like I know you. You're a good dude. You don't want to screw people over. You do want to
yep.
help them. But surely there are, like you just said, there are slimy people you've met. How do you deal with that and work through that?
I had a really hard time with that when my first job out of
Okay.
college. Um, I gotta be careful.
Sure.
I worked it. I met some people through my work that really, really turned me off, and
Okay.
to the industry, and I saw advisors that. So the big thing with being an advisor is telling a story to relate to your clients. Nothing wrong with storytelling; like it's great
Right.
if you're using it in the right context, right?
Right.
I met plenty of advisors that used the Christian story to get clients.
Really?
And the first time I interact with that, I was really, really close to like having an outburst and saying
Yeah.
something. And
Oh,
like it was heartbreaking for me to see this person kind of fall off that pedestal. And it was really, really aggravating too. Like I wanted to quit that job immediately.
were they Christian?
I don't
Because
think
like,
so.
because like to me, if you're connecting with a person, Christian to Christian, and saying like, and then trying to make that sales pitch is a little crass, but you know what I'm saying? Trying to make that like recommendation maybe, because I think a sales pitch can be a recommendation.
Yep.
Then I'm kind of more okay with it. Like I'm just like,
Yeah.
okay. But if you're just like somebody who doesn't care, some sort of, heathen, we'll say,
Yeah. Yeah.
and you're
Pagan.
yeah, pagan heathen, and you're just like, oh, this reminds me of, the rich man, and it's like, oh, jeez, that would be rough.
Yeah. I do not think that this person was a Christian. I think they purely used that to with certain clients, right, who they knew were to get that kind of
And that's just disgusting. Yeah,
it is disgusting. It's totally disgusting.
yeah.
Um, yeah, so I had a hard time with that, and a big thing in this industry that I think has calmed down a lot with the rise of kind of lower cost investing in index funds
Mhm.
is products, like selling actual products as opposed to helping someone invest their money. Like it used to be the case that you would sell an investment vehicle, whether it was like an insurance plan that was tied to the market or something like that, and that or you would just be like a stockbroker. You'd call and say, "Hey, go buy GameStop," right?
Right,
That's you're going to make money on this, and then I'm going to make money off commission.
right,
Well, they kind of phased that out and got the more into the financial planning being the big kind of push that advisors have, and they take this approach of I want to help you build your financial plan and accomplish your goals. It doesn't matter what you invest in anymore. And so they kind of moved away from that, and I got some really good experience seeing how that actually helps people
okay,
and interacting with a couple of guys that were good Christian men who really, really cared about their clients. And when I saw them interacting with the ones that weren't Christian as well, and like being like, okay, so I can be angry about this, but
hmm
that doesn't mean that I need to leave and get out of this industry. And so they were really good examples to me, kind of like being a light in the darkness, as
right.
cheesy as you want to make that out to be like.
That's good. And I would argue that like I think, and this is something I've been thinking about in the past few months or maybe year, is like that is often the instinct for a lot of people. Is like, well, I don't like this
Yeah.
industry. I'm just going to get out of it. I don't want to be
Yeah.
around slime. And I think that's fair. You gotta protect yourself. I think that's hugely important. Like what you're around influences you, no doubt about it.
Right.
Protect yourself. But at the same time, like then you're just you've turned a bad situation worse, right? Like you could have helped.
I'm
And
giving up. I'm taking the easy road.
well, I do think it's like to some
Personal opinion.
to some extent you have taken the easy road. But again, it's also like if you're gonna be around people who are gonna like get to you and cause you
Yeah.
to be
True. True.
like get you to lose your faith or whatever, like
Of course.
leave. Like that,
Yeah.
it's not worth losing your soul over. Like
Right.
if you are someone who's strong in the faith and can like withstand the pressures of it, I think you should stick around. You will do good. You will be that light. You will, you'll be that like that lighthouse, right? Like you'll
Yeah.
guide people. You'll help. Um, so I think that, but that's such an instinct that say conservatives and specifically conservative Christians have, is that like, well, I don't like this anymore, so screw it, I'll leave. Like we
Yeah.
abandoned the universities, right? That's what we
Yeah.
essentially did, and now look what happened. We abandoned Hollywood. Look what happened. Like that's how you lose institutions. Is you just kind of like, well, I'll go do this other thing,
Yeah.
and then you lose it all. So I'm glad you found a way to stick it out, because I think um, that's helpful. That's good. We need that. We need people there that are at least like, you know, being that light, holding that, holding that torch, being that lighthouse.
Right. Yeah. It's interesting there. When I, first started, I was ready to leave. Dealing with those people, and so my wife Katie and I went through a really tough year, our second year of marriage. She had a really hard time being sick. She went through some pretty bad stages of depression as well. And that there's like a 6 month period where our marriage was really tough, life was really tough, work was really tough. Um, we like I don't even know what happened, but for some reason, as she went, further into despair, the more that we prayed and the more that I attempted to take care of her, because I don't think I did a very good job, the Lord just blessed me with this immense optimism
Oh, wow.
about like our future and everything that was around me. And she was in like the dumps, and I was like on cloud 9 for 6 months. But it wasn't like, "Oh, I'm so happy. Bye-bye,"
Oh,
It
yeah.
was like we're going to get through this. Everything's going to be good. Like that constant reminder to her was like bolstering to me in my faith,
Hmm.
and that like changed my whole perspective, like similar to that job and that internship at the law firm where I decided like I want to make money to marry this girl and build a life with her. That time in my life was like, I need to be a light. I need to be like this optimistic person and change the way that people see me and interact with me. And since then, I've been like just the most. My mom makes this joke. She calls me the Eternal Optimist.
Yeah.
That everyone at work notices. I've had 3 jobs since that time with her, and like my nickname at all 3 jobs has been Sparky, because like I'm just excited about everyone. I love everyone. I'm happy all the time. I'll take whatever work people want to give me. Like always super happy. And so it's been really cool to kind of really actually feel that light and blessing like just lived through me because of that really challenging time that we lived through.
Yeah, that's awesome. Like you had that like, it seems like you were like filled with righteousness,
Yeah.
to make it sound awesome. Like you're just
Yeah.
get like that fire of just golden righteousness.
Yeah. And I mean it's not like I was out evangelizing. I'm
No,
not very good at that stuff, but I
I mean,
felt like I was through my work, right?
right.
I was living and doing the best work I possibly could, and that was the light and the example that I was living.
Yeah, that's awesome.
It was pretty cool. Yeah.
That's great. And it's now like, is work easier now? Is it better?
Oh
Or is
yeah.
it still a little bit like every so often you have that like hurdle or that obstacle?
I honestly have not felt like there have been some where I've had my own impatience or my
Sure.
own frustrations with people. Um, so one of the jobs I had a fantastic mentor. He was a former boss, and I still talk to him almost weekly right now.
Okay.
But for the longest time, he's a good Christian man, devout Catholic.
Hmm.
he was on this pedestal. I put him on this pedestal
Sure.
because of everything he taught me and everything I learned from him. And then one day he had a human reaction and he just has a short temper,
Yeah.
and he fell off that pedestal for me, and I was crushed.
Oh,
Like,
wow.
I have never felt that crushed, but I was like, this role model for me. And then it was like he's nothing anymore. And then I had to step back and realize he's just a human.
Yeah.
Like, that's just how it is. So that's the only like real challenge that I feel like I've had in terms of work since that point, which is kind of wild. But I feel like in all of the teams I've worked on, I've kind of always stood out. Um, not because of I'm amazing or anything, but just being that sparky kind of person. Everyone pays attention to that and sees that.
No, I think that's true. You have an energy to you. Like you do kind of have that like Energizer Bunny kind of like smile. You got that smile
Yeah,
right there.
and I laugh at everything.
I know you do have like a joy to you that
Yeah,
I think is good.
yeah,
And it's not phony like a lot of people do kind of like that phoniness to it. Yours is genuine. So it doesn't
yeah.
surprise me that you get that Sparky nickname everywhere you go.
It's my favorite.
There you go. It's earned. It's well earned. Yeah. Oh man.
All right, so we got super sidetracked from
Mm.
retirement accounts and
Yes,
401k
it was a
plans.
good sidetrack. I'm glad we talked about it. Yeah. Let's see. We're talking about 401ks, 403bs, rolling them over. Let's talk about okay, you set up your IRA, your Roth IRA. You put money into it. There's still another step, if I recall. You actually have to invest in something.
Yeah, right.
I have like so I do spoiler alert, I do enjoy reading personal finance as like for fun.
Nice.
Like I enjoy a good Dave Ramsey book.
Oh yeah, I love Dave Ramsey.
He's a good dude.
Yeah.
And I enjoy just like reading personal finance. It's fun for me. Because it makes me feel like I'm doing things right. It's
Yeah.
like, at least I got this going for me. Uh, but it's how I feel like a winner. I read Dave Ramsey.
Every
But
morning.
yeah, every morning I'm like, oh yeah, I did do that today. Yeah, I'm not a failure. Great. Yeah, my dad is proud of me. But like you hear the story of like people who like invested their contribution to their IRA, but then they never invested in the market, right? Like I don't know if that's real, but that's the anecdote that goes around.
Yeah. Yeah.
So what can we kind of go into what are like some of the different investment vehicles? Or no, we just talked about vehicles, investment options, I guess would be
Yeah.
the I mean the obvious one being stocks, but I
Yep.
would imagine you would not recommend people just invest in stocks and they're using their Roth IRA.
Yeah, you have to be careful with that. So let's go really high level real quick.
Okay.
Super basic, you've got 3 different types of investments, theoretically. Cash, your money sits in cash. You can have what's called a money market, which is supposed to pay a little bit more interest than like a regular checking account, but nowadays they don't.
Yeah.
You have equities, so stocks, you're owning shares of a specific company. You are buying ownership position within that company. So one stock in Google, you theoretically have 0.000000001% ownership of the company, which means that you share in the earnings of the company. If they pay a dividend as they grow, you should grow with them through your ownership. And then you have what's called fixed income
Okay.
or individual bonds. That's more of your safe kind of investment. So you buy the bond, corporate bond. So Google can put out debt and you can purchase that debt. And the reason it's theoretically more safe than an equity investment is the debt, the debtor. So Google puts out a bond, they're obligated to pay that bond back at the end of a certain term.
Right.
So you sign a contract, they sign a contract. Hey, we're issuing this 7% bond for 10 years. We, at the end of 10 years, you buy our bond for $1,000, we'll pay you back $1,000. Over the course of it, on an annual basis, we'll pay you 7% interest, simple interest. So 7% on 1,000 every year
Yeah.
is what you'll get, and then your money back at the end of 10 years. So that's where it's theoretically more safe, because there's an obligation in a contract to have that paid back. You can buy those bonds in the open market at a discount. You can buy them above their premium, And with that, the interest rate fluctuates. So what you actually get, your yield can be slightly different. So those are your kind of three overarching choices within the market, basically.
Okay.
I mentioned it earlier, that 60-40 stock to bond portfolio is kind of the basic, what people coin as the balanced, the moderate portfolio. 60% in equities, 40% in bonds. That equities are very volatile. So that price you see up and down all the time, people are talking about it. Jim Cramer's screaming about it.
Right.
Your bond prices are going to be less volatile. So the goal of that type of portfolio is to kind of level it out a little bit, so there's less volatility, so that
Okay.
when the market's down 30% last year, your portfolio wouldn't be down as much, because not all of your portfolio is invested in stocks. Some of it's invested in bonds, which weren't down as much.
Right.
Kind of like dampen that volatility a little bit.
Sure.
Diving in a little bit further, you have options like you could go out and buy a position of Google. So one stock, I think it's like $1,100, $1,500, something like that, for one company share. Or you can do what's a lot more common nowadays, which is buy like a mutual fund or an ETF.
Right.
A mutual fund is a basket of securities managed by a portfolio manager, usually sticking to some sort of theme or strategy, whether that's the S&P 500. They want to track an index. They could follow some sort of mandate of, hey, we're looking for what's called like US large value. So we're only going to buy those types of companies. But when you buy a share of the mutual fund, you have access to all of those companies' growth, basically. And you then have some more diversification in your portfolio.
Sure.
And then, so that's a mutual fund. You get one share of that. You theoretically have a lot of different pieces of stocks in there. You can have equity mutual funds. You can have fixed income mutual funds. There's always fees associated with that. So you're going to pay some sort of management fee in there. And then you have what's called an ETF, or an exchange traded fund, which does the same sort of thing. It buys a basket of securities, some sort of theme associated with it. But it's more equity-like, in that you can buy and sell it throughout the day. What I forgot to mention about mutual funds is they settle at one price at the end of every day. So if you go in at 9 a.m. and you buy a couple shares of a Vanguard mutual fund, it won't settle until the end of the day, and you don't know what the price is until the end of the day. So it can move up and down, it can move against you, it can move for you, but your position doesn't settle to the end of the day. An exchange traded fund operates more like an equity position, where you could go in at 10 o'clock and buy it for whatever the price is at 10 o'clock. And then you could go in and sell it at 1 o'clock for whatever the price is at 1 o'clock, and theoretically make a gain or a loss in that time frame.
Right.
They are there's a lot of different ins and outs to all of them. So I'll stop talking for a second.
Okay. That's all good. What about like targeted funds? Because those are the ones I invest in, because they keep life simple. Can you kind of dig into those a little bit?
Yeah, so a target date retirement fund is basically going to do all of that for you. Everything that I just talked about, it'll just kind of take care of it for you. So the goal with those is, let's say you buy a 2055 target date retirement fund.
Sure.
Over time,
2055 being the day you would or the year you would retire.
Theoretically, yeah. And because you bought that fund and that specific date, that doesn't mean the fund's going to go away in 2055.
Right.
It's just that's kind of when you think you're going to retire. And so what it does is the portfolio kind of changes its composition over time. So right now, since that's 34 years away, that portfolio is probably going to be a little bit more heavily invested in stocks than bonds. So it might be 80 or 85% stocks.
Right. So
and then
then
theoretically, yes.
Does that also mean the gains would then be higher though too?
Yes. Yeah. Yeah, exactly. You would have a better opportunity to make more of a return the more risk that you take.
Right.
So as that portfolio, as time passes and you get closer and closer to retirement, that portfolio is going to lower the equity exposure, as you theoretically prepare for retirement. So
Mm-hmm.
that ideally 5 years out from retirement, if the market crashes, you don't lose all your money and then not have the time to make it back. So they'll move towards more of a 50-50, 40-60, 30-70 type of composition, so that by the time you get to that 2055 year, if you're going to retire that year, you have the funds saved and they are in a relatively safe. There's still usually maybe 15 or 20% of equities, but it's mostly fixed income and it's mostly safe so that you can start drawing on it.
Okay, so that makes sense. So as that type of fund, it's a fund, I guess. Is that what you call it?
Yep.
Targeted fund. As it matures, it gets less risky, which is what
Yep.
you want as you're right. If you're 2 years away from retirement, you don't want you don't want it to the moon type of stocks.
Yeah, right. You're not you're not betting at that point. Yeah.
You want to save what you have and just kind of keep making a little bit more and more.
Yep.
At that point, too, theoretically, you'd have a lot more money saved in. So it's the 2% goes a lot farther when you have a lot. The raw return.
Right.
Yeah.
Right.
So let's scenario wise, like let's say you're just like let's use my fiance as an example. You're not super like financially into it. You need to have a savings account or a retirement account, but you're not like you're just gonna go with whatever the company gives. Not necessarily what the company gives you, because the 401k they're gonna invest that for you. You're just gonna pick up your slider. We talked about that, but you're gonna open up a Roth IRA. What is like? Should she go for like the targeted fund, or should she go for like the mutual fund? Should she just be like, I'm picking stocks, and you know what, we're gonna roll those dice, like like what's generally like what's the like set it and forget it thing people could do, where it's just like I just want to cover my bases, but like I can't dedicate too much time to this. I'm scared of it. I just want to like get it done and then panic and then watch Bachelor.
That's what my wife does.
Yeah, that's right. It's like what all girls.
So one of the things that I am a big proponent of people paying attention to is the fees that you pay with these funds, because a lot of times what you don't see and you don't know is the expense ratio that you're paying. So personally, I'm not a huge fan of targeted date funds because of that.
Oh, interesting.
Because they generally have a higher expense ratio.
What is an expense ratio? We can get a little in the weeds on this.
Yeah, so an expense ratio is basically what you are paying the investment professional that manages that fund. So they can range anywhere from zero. There are some Fidelity index funds that are zero cost, up to 1.5, 2.5, 3%, depending on like the complexity of the fund.
Sure.
I mean, if we really wanted to get into it, there's some like daily liquid alternative funds that are like a 4% expense ratio because they're doing things like buying and selling options and whatnot.
Right. Well, that makes it sound like a mutual fund then, because I know that's like I personally tried to avoid mutual funds because I know they come with fees because they're actively worked on.
There are
funds were similar in that regard.
Yeah, there are passive mutual funds as well. So there are low cost mutual funds. It really depends on which one it is, which targeted date fund. So it's super important. Like if you know the ticker symbol, so the little 4 or 5 letter combination that they put on whatever your investment is, and you Google it along with expense ratio, you can figure out how much you're paying. So that's like, it's an annual cost that you pay. So it's usually something like 1% a year, similar to what a financial advisor might charge you.
Right.
And that just gets automatically taken out of your investment over time. So you don't really see it because ideally your position's growing, but what you're paying is a percentage of the assets that they have control over.
Oh, interesting.
Mm-hmm.
So it eats into your earnings essentially, into your interest. Okay.
Yep.
Okay. So what would you recommend then? Is it just approach those, but approach them with caution, with research, or is it avoid them altogether and do this other thing?
Both. How about both?
All right. You have to explain it though. Yeah.
Yeah. So absolutely, in everything that you do in terms of investing and saving, you should approach with caution and do research on.
Okay.
The level of research you do depends on how much you want to, right? If you want to be like me and read the prospectus and go through the fact sheet of all these, then you absolutely can, but you don't have to.
Okay.
Being aware is going to make you a much more intelligent investor in the long run, and being able to know what you're paying and where that goes is really good for you in the long run. Generally, for people who just want to put it into something and forget it, it would be better to choose something like an index fund. So what a fund that's tracking like the S&P 500, or the Russell 2000. Like what they're doing is they're buying hundreds of stocks that are theoretically tracking the market. The expense ratios on those are usually like 10 basis points.
Okay.
So 1/10 of 1%.
Right.
Because the manager's not doing anything other than tracking the index.
Right.
So whatever the index does, he follows, basically, he or she follows.
That's probably what a computer program I would imagine anyway.
Exactly. It's mostly a computer program, right?
Right.
And so that's going to help you because over the long run, over the 10-year, 30-year kind of time frame, equities on a whole return about 7%.
Okay.
So if you're getting 7% over 30 years, that's great compounding.
Yeah.
And then you can kind of combine that into something else. If you wanted to buy like Vanguard Total Stock Index and Vanguard Total Bond Index,
And
do
then
60/40, you
your
would have your combination there. And then it's just kind of up to you to change it, 30 year, 10 years out, 5 years out, whatever you want, if you wanted to. But there are arguments and there's research behind being more heavily invested, because theoretically, if you retire at 60,
Mhm.
most of us aren't going to die at 65 or 70.
You could have up to 30 to 40 more years left.
Right, exactly. And so you want to make sure that you're still invested
Mhm.
well to grow so that you don't outlive your assets.
Right.
Because that would be a horrible situation to be in.
Yes. That would be rough. Unless I would also throw out the other retirement option is big family, but that's
Oh, yeah.
that's the Catholic option. It's
Yeah, that's a good option.
I'm not gonna say for retirement, but I'll have 8 kids.
A big family.
There we go. One of them will take care of me. All right.
That's right.
Just
Just hope that one of them goes into finance and makes
yeah.
money.
Well, yeah. If they all just like give you $100 a month, that's
I don't
$800
think
a
that would
month.
be enough.
That's rent. Okay, that helps. The chips in. So okay. So that's good. That's good to know. What are there any like books you would recommend on like retirement savings? Like
Oh my gosh.
specifically? Obviously there's like a gajillion of them,
Yeah.
but is there one that's like a good intro? Like, hey,
Oh,
do this. Can I recommend one and you can tell me if it's good or not?
sure, sure.
I Will Teach You to Be Rich by
That one's pretty good.
Rameth Sethi, I believe is his name.
Yep. Yep.
I liked that one. It was very practical and very like it named names, that's what I
Yeah.
liked. It said invest in this fund. It's decent. I think it's a good like if you've never invested before, if you've never opened an account, I thought it was a really good one to
Yeah.
just get you started. And then from there, obviously there's a gajillion options. A lot of them are scams.
I wonder if I think my books are somewhere else for that topic, which is unfortunate. I think there are a lot of really good books and there are a lot of really terrible books.
Sure.
I've not read I Will Teach You to Be Rich, but I've read a lot about that author.
Yeah.
I don't think there's anything wrong with that. I think Dave Ramsey has really good books on it too. He
Does he?
loves mutual funds. Yeah.
Okay. I only read Money Makeover, so that was more about debt than actual
Yeah.
retirement.
Yeah. He talks a lot about mutual funds because his whole approach is like, it's something, I'm going to make up numbers, but it's like 50% into US stocks, 20% into international, 30% into bonds, something like that. And he names a couple like specific mutual funds that he cares a lot about, low cost index investing.
That's great. All right.
So he's got really good. I love Dave. He's just
Yeah.
got fun stuff.
I think he's great. People give him a hard time, but it's like, you know how many lives he saved? Okay,
True.
I like books that like name funds because if
Yeah.
if you just told me like find a mutual fund that's good to invest in, like good luck. I gotta
Yeah.
learn like finance jargon. I gotta
Yeah.
like and then they're all and the confusing thing is like there's like there's like Vanguard and Fidelity funds, but they're also banks, and it's it just gets hard. It's like just give me that ticker symbol, so I can just type in the numbers and go eighty
Bye.
percent or whatever, and then I can be done.
Yeah.
Because I don't necessarily, it's interesting, but it's also a black hole that I can get sucked into, but it's also money I can't touch for another 40 years. So it's like,
Yeah. Yeah, it's definitely tough figuring out the right place to put your money. Um, I like it because I love to do this stuff.
sure,
But I got a specific name for you. I don't have any money in this fund, so it's not like a plug for me or anything like that. But
okay,
I read a book. So I've got this book right now. It's called How I Invest My Money,
okay,
and it's basically a bunch of different financial planner professionals and how they personally invest their money.
okay,
So like a lot of times you hear, oh, you need to do this, you need to do that, but it's like, well, how do you actually manage your money?
right. This is like a good skin in the game kind of principle.
Yeah,
Yeah.
yeah. And so there's a lady in there who started her own ETF, and the ticker symbol is FRDM for freedom.
Oh, nice. A free.
Yeah.
Oh, F.
And so what it is it's an emerging markets ETF
Right.
that buys into companies operating in free
Free
countries.
country. So it's got.
Right.
Okay. So
So
like
it screens
Singapore.
out, yeah, it screens out non-free countries. So like China does not get,
Nice.
no funds are purchased for Chinese or Russian companies in
Right.
this
So that
exchange traded fund.
and it's assuming that like if your company is based in a free country, it's going to grow faster than one that's not based in a free country.
Yep.
Therefore, you make tons of dollars.
Yeah, exactly. It's a pretty cool concept, and I am planning on putting some money in there at some point.
That's a fun concept. Okay, I'm glad you told me
Yeah.
about that because I do
Yeah.
like I'm not gonna put it all in there, but like I like the thesis. I like
Yeah.
the I
And
like
that's the thing that I always tell, like whenever I talk to some of the other guys from Delt and they ask about this stuff, like if you really want to get into the weeds on it, find something you're passionate about, find something that you know, and invest in a company that does that and you know how they do it. So like if you really like marketing and you really like the way that Google does marketing, let's say, you would like do research on them and be like, okay, I feel comfortable, I understand what's happening here, so I'm going to invest my money here. In my opinion, that's a really good approach, and that gets people more involved in the actual business side of it versus just the, oh, financial markets, I'm buying the market kind of thing.
but
um,
that would be that's like fundamental tradings, right? That's like the fundamentals. So
yeah, it's called fundamental investing. Yeah.
you're not a technical trader.
No.
Or what's my favorite one being? Oh, what is it? Because I went on a little trading kick. What's the wave one? Elliott wave theory?
Oh
Oh,
yeah.
that one's glorious. Have you looked
Polar
at that one?
bands.
Yes.
Yeah, yeah.
Oh,
I'm
Bollinger
I'm
Band.
with you.
Elliott wave is my favorite because it's all fractals and it's like, well, it's all part of one giant wave, and it's like, what? What's going on here? Yeah, if you ever want to laugh, Elliott wave theory. It's hilarious, and people swear by it.
Yeah.
Yeah,
Those people that do technical analysis, they can make money.
yeah,
It's crazy. But yeah, no, so actually the way that I was trained is more fundamental value investing is what that's called. And
sure.
it's
That's more,
Warren Buffett.
yeah,
Yep. Yeah, exactly. And I like that a lot because I like understanding how businesses work
sure,
and then investing in them, and less of just assuming that buying the market does what you want it to do. Because also I want to support companies that I believe in, right?
sure.
If they're
Good
doing
point.
something good in the world, I want to put money towards that.
Okay, that's a good point. What? Okay, so we've talked IRA, 401ks. Is there another retirement vehicle I'm missing? It seems like those are pretty much everyone's options right there.
So
Oh,
there are offshoots of all of those,
okay,
right? So you could work for a company that still has a pension plan.
sure. That would be
So
nice.
yeah, that would be really nice. I figured GM probably still did.
They did not when I worked there. I was not one of them. It did have a very a nice employee match.
That's good.
That was nice.
That's good. Yeah, so those plans are, you don't give any of your own money from your paycheck into it. The company puts money in for you.
Right.
And over the long term, it grows a lot because it's pooled investment.
Right.
And then they pay you out a certain percentage of your earnings over some other kind of not very complex math equation, honestly.
Yeah.
But you get paid out when you retire, so that you don't have to basically have those funds saved on your own or invest them on your own. They do it for you.
Right. They take care of it for you.
Yeah, which is great, because they paid a lot, but they don't do that anymore because it's expensive for companies to do that.
Right. And then also mobsters get involved and they launder out that money and stuff. That's what Jimmy Hoffa did.
Yeah,
The pension fund, man.
I love
Uh, okay. So let's another scenario. Let's say you've got somebody 401k maxed out or like super healthy, we'll say.
Yeah.
IRA maxed out.
Yep.
What like there is this like the problem with the retirement accounts is you can't touch the money until you retire.
Right.
Which is good. Like there's benefits to that, but
Yep.
the cons are like I can't use that money now.
Yep.
So like, what are some kind of like, that's why like I think personally I think you should get your IRA maxed out and have a healthy 401k, but don't go too overboard because then you're locking money in a safe you can't get to, and you might you want to buy a house, you want to buy a car, you have medical something that comes up, or your dog gets sick, whatever. Like there's a balance to be had there. Once your bases are covered, and obviously keeping it in a savings account or checking account is stupid because you're just losing money because of inflation. So like what's kind of like what's like an in between? Like say you got retirement nailed, perfect. What would you then do? Like what's something what's something someone could do if they wanted to kind of be in the market, get some good growth, but not get screwed over, essentially.
Yeah. Well, so first off, taking a step back, I think before any of that, you should have an emergency fund set aside.
Sure.
So whether that's 1 to 6 months worth of expenses, kind of cover yourself in case something like your car breaks down or you lose your job or something like that. So that's really important.
That's textbook Ramsey right there, sir.
Yeah, exactly. It's also textbook financial planning. But so basically the next
one thing I do want to say about those, because this is something I recently learned about emergency funds that make a lot of sense once you realize it, but may not be apparent to you, and something that like really chilled me out when I first learned about emergency funds, because they say, what did you say, like 6 months worth of expenses?
Yeah.
But chances are during that emergency period, your expenses aren't your normal expenses as like right now.
Right.
So like a lot of like when I first thought that, I was like, shoot, I'm behind. I need to have 6 months worth of salary saved up.
Yeah.
That's not. It's got to be 6 months of you can survive, not 6 months of flourishing, which is what I'm doing now. So
good.
Yeah, great. Just flourishing. I think that's an important distinction for people when they think of emergency funds. Is like, this isn't what do you need to keep your lifestyle the same. It's what do you need to get by during the hard times.
You know what? That reminded me of the episode of The Office where Michael buys a ring for Holly, and they're like, Michael, how much did you spend? He's like, well, they said like 6 years of salary. They're like, what? It's supposed to be like 6 months.
6 weeks or whatever. Yeah.
Oh, that's so funny. Yeah, but that's a good distinction. It's expenses, not salary that you're saving. Yeah.
Right. And I think it makes that emergency fund less intimidating. I'd argue. Yeah.
Yeah. And that's also something you're saving for, if you want to call it contributing to regularly, right? You should be saving a little bit every single month, and so you can kind of build that over time at the same time that you're building your investment account. But really the other option there is what we call taxable accounts or brokerage accounts, and you can title those in a multitude of different ways. So if like you can open an account, John Alorty brokerage, it's in your name, you have ownership to it. You can open a joint account, so you and your fiance can open an account. It's in both of your names, you have equal ownership to it. You can get married and then everything you have is half hers anyways. And you can go as far as like getting a trust account set up so that the trust owns those funds, and then theoretically you pass away or something happens to you, the funds are dispersed according to the trust document, and not whoever becomes the next owner. So that's a good thing to have. But the rest of it, and actually the broad, most of high net worth wealthy people, their money is not tied up in their 401k or their IRA.
Right.
Their money is in these brokerage accounts.
Right.
So, I worked with a lot of really, really wealthy people who didn't even care about their 401k. Like their 401k maybe had a couple $100,000, but their taxable account had a couple $1 million in it.
Right. Well, I mean, that's because they can, that's money for them to use, right? That's money.
Yes.
Yeah.
Yep. Yeah, but it's also still a useful retirement savings vehicle.
Right.
It's just taxed differently, right?
Sure.
So it's
that's
going
a
to
good
be
point.
taxed in the moment.
Yeah.
So if you were to buy Vanguard Total Stock Market today, and next year, after 1 year and a day, and you sell that fund, let's say it gains $1,000, you're going to be taxed long-term capital rates on that gain that it made. So $1,000 a gain, you will have to pay taxes on that.
Right.
If you don't ever sell it, or you wait forever to sell it, you don't have to pay taxes on it until you sell it.
Right.
If you sell it in less than a year, you pay ordinary income rate on it.
Okay.
So that's one thing to be cautious of in those accounts, but that's where it kind of pays to be long-term investor.
Right. Sort of pays to give your money to the finance people so they can just spend your money.
That's what I do.
Man, Fed, man. Okay, that's good to know. Those are all good. Yeah, I like that. All right, I want to throw out random topics at you.
Perfect.
Your thoughts.
Let's go.
All right, because I go down rabbit holes sometimes, and I need someone to pull me back, pull me out of the rabbit hole. So, have you heard of this thing called infinite banking?
No.
Okay, Google it and get back to me. Because don't do it now. It's weird.
Okay.
But it's something I came across, and it's one of those things where it's like it makes sense, but it feels like a scam. So yeah, just maybe we'll do this as an aside, just for my own personal edification, just to know.
We'll just do another episode. Just have me back on.
Episode. Yeah, you can either debunk or evangelize infinite banking.
Nice. All right.
It involves a lot of like taking out an insurance policy and then taking loans out against it. But because the insurance policy like pays out 8% and the loan is like 4%.
I know what this is.
You know what this is? You've heard of it?
It's not called infinite banking in the sense that I've had it, but yeah, I had a couple guys try to sell it to me a few years ago and to the clients that I was working with. Yeah.
Yeah, it feels like a scam, but the numbers make sense.
Yeah, the numbers make sense, but ask the guy who's selling it to you to explain the numbers, and he can't.
He can't, right? Like, that's the problem. It's never like an intelligent person, but then it's just very weird. There's weird. Yeah.
It's so funny when these. I mean, I had like, at this firm that I was at, we had a lot of very, very wealthy clients.
Yeah.
And at one point, this company came in and tried to sell us on these insurance plans, and I don't remember what they were called. I don't know the term infinite banking, but I'll look it up. But it sounds very similar to what these guys were hawking.
It's like a lifetime insurance plan or something like that.
Yeah, but basically they presented this, this slide, this deck, and they're going through it, and they skipped over the numbers pages really quick. And I'm a numbers guy, so I like jumped into it, and I was like, wait a minute, can you explain, what are these numbers here? And they're like, we'll have to get back to you. And I was like, seriously? You can't explain what's happening here? It's on your deck.
Yeah. It's very weird. I've come across, I have looked at the numbers. It kind of makes sense. It works on the whole, like, it's like percentages when they go down, they're not linearly down when you take, like, if it goes down by like whatever 5%, like they're paying 5% a year, it kind of goes down not linearly but kind of quickly, right? It's kind of slow and then speeds up.
Okay.
It kind of plays off of that. I don't know. I'll let you Google it. I'll send you a YouTube video that was really made a lot of sense, and I was like, but I'm like, it was one of those things where I saw it and was like, I know this is a scam,
but I like it.
But I like it, and I just don't know where they tricked me. It's kind of like a magic trick, and you're just like, I know it's not real magic. I just don't know how you did it. Like it's that. It felt like a sleight of hand.
Yeah.
All right. What about, okay, so
I love magic.
Okay.
I
Thank
don't
good.
know Magic, but I love to watch it.
That's fair. I enjoy Magic too, actually. Yeah, that's fun. I don't really like card tricks so much, but I like
Okay.
other Magic is good. Um,
All right, back on track.
sorry. I'm glad we both agree we like Magic though. Fire.
Oh,
Financial
yep.
retire early.
Yep.
That I personally, it seems like a lot of people grinding really hard for 15 years to live a life that's substandard for the next 40.
Yep.
But would love to know, like, have you seen people do it? You know, what are they? Is it working for them? Any sort of experience with fire folk?
Yeah, so I've read a lot about it. I was on the train for a while
Okay,
until I realized what it is it's high paid computer analysts and computer programmers that make way more than they need to make
right.
that can live off of 30 or 40% of their income
Yeah,
for an extended period of time. And these people do it, and you can be super frugal, and there's nothing wrong with that. My brother-in-law and sister-in-law are super frugal, and they're really good at it. I'm not very good at that, and
sure.
that's just like that's a challenge. And so, but that's also the hard part. Is like if you live like that for 15 years, like what then are you doing with your life for the next 40?
Right.
I mean, if you're living out your calling, you should be working and living and glorifying God in those actions. Not saying you can't do that, but like we're doing that through our work right now. So, you don't want to be sitting around for 40 years doing nothing,
Yeah.
right?
Yeah.
Kind of my stigma with it.
I looked into it, but I reached a similar conclusion. I was like, okay, you're gonna work really hard and be real frugal for 15 years, save up a nest egg of like it's like save up like $1 million, and you're gonna make 4% a year after that. So you're gonna live off 40 grand a year after that, after
Yep.
working really hard to save up $1 million. If it's for you, great. It's not for me.
Yeah,
Uh,
I agree.
it just didn't seem. It did not fit my personality. But
I mean, it's a good approach because it kind of changes what's normal in the world today, right? We're not
yes,
spending everything that we have and just living our life buying whatever the heck we want. Like people are being disciplined and super cautious with their money, and I think that that's really good. And if you build that habit through
yeah,
attempting to do this, then you're better for it.
that's a good point. I do think that like the extremes influence the middle. And
Yeah.
if the extreme is fire, that's a good extreme because it'll influence the middle to be more frugal and to actually worry about retirement and all those things. So
Yeah.
to that extent, I think you're dead on. Okay, that's a good point. That's a very positive way to look at it. So sparky. You're just so sparky. Okay, I think those are my only two kind of wild card questions were infinite banking and fire. Okay,
Sorry that I couldn't help more on infinite banking.
it's really okay. I'm glad no professional is taking it seriously. That kind of drives with what I thought. But if you could look into it, though, I want to send you a YouTube video, and I'd love to know. I'd love to know where the trick is because I couldn't
Yeah.
find it.
Yeah.
Again, it's like a magic trick, and I was like, where was that? Where did he hide it? If you can show me where they're hiding it, I'd appreciate it.
Awesome. That sounds like fun.
Cool. Is there anything else I'm missing in this equation with retirement and savings? I know we just spent like 2 hours talking about retirement accounts, which is heavy, but it's so important and
Yeah.
so
Yeah.
under spoken about. And I think that like it's such an important thing for men to know about, or like family men especially. Like whatever, if
Yep.
you're a single dude, you should have some savings, but whatever. I don't really feel that bad about the 7-year-old bachelor working. All right, great, whatever.
Yeah.
Okay, that sucks. Like you're a 7-year-old bachelor. That's what you've been doing, man.
Yeah.
But like the family, there's just so much riding on you as a man, as a father, as a husband, that like making sure your retirement is solid and making sure you're taking care of yourself and your family, I think is super important. So is there anything
Yeah.
I'm forgetting, anything I'm missing that you can think
Yeah.
of?
Well, so there's two other types of accounts that we didn't talk about because you
Okay,
mentioned a lot of like medical payments and stuff like that.
sure.
So there within that subset, there are two types of accounts. One's called an FSA, a flex spending account, and one's called an HSA. Your flex spending account is similar to that pension plan where the company manages it, you pay into it, and then you get like a little debit card. So
Mhm.
the max that you get a year is like $2,500. Um, yeah, that you can use, and it's pre-tax dollars. So they'll pull it out of your paycheck automatically, and it funds this account that you can then use for medical expenses, medical bills, that type of thing. It's nothing other than that. It's like a prepaid debit card that repeats every year. It doesn't roll over or anything like that. If you open an HSA and that's associated, you have to have a specific type of insurance plan. It's called a high deductible. So it takes longer to reach your deductible because it's a larger dollar amount. But with this HSA, it's more like an investment account. So you pay in a dollar amount, $200 a month, $500 a month, and it funds an investment account that can be used for medical bills, things like that. But you have control over it. So you could theoretically have an HSA account that you invested in the market, and so you put in $5,000 a year, but you don't ever spend that money each year. And that could grow to 10, 15, 20. Now, the key with that is the funds can only be used for medical expenses. But it's pre-tax dollars that are growing tax-free and that you're using tax-free as well to pay medical bills. So that's a really big benefit. Not super common, but really beneficial in the long run, especially if you are, there's medical history in your family.
If you're like diabetic, it seems like something you should really look into. Or if you're
Exactly, yeah. So my wife has type 1 diabetes, and we both have an FSA account with our individual employers that we both fund entirely, because diabetic supplies are ridiculously expensive.
Sure, they'll gouge you, no doubt about it.
Yeah. So that's really beneficial.
That's good to know, and that's a good. I'm glad you brought that up, because there are people who have kind of chronic issues that would be helpful for them to have, because it'll save them on like the taxes and all that kind of stuff.
Yeah, and it's one of those kind of automatic savings as well, because it comes out of your paycheck, so you don't really think about the impact that it has, which is good in the long run, to have that kind of stuff. So then the other one that we didn't talk about as well, especially as it relates to being a family man and stuff, is they're called 529 plans. So it's a college saving vehicle for your children. So basically what it is it's an account in the name of your child that you are the what's the word? The controller of, basically. And these funds, depending on your state has different tax deductions associated, like limits. You contribute to this account and it grows, and then the funds can be used tax-free to pay for college. And they actually updated the rules last year, and the funds can actually be used now to pay for K through 12 private school as well.
Oh, and is that across the country, or does it matter what state you're in?
What the funds can be used for across the country. Every state has different rules and deductions associated with them. So Missouri is a really cool state where you don't have to use the Missouri plan. You can choose any plan. Every state has their own 529 plan. And so I use like the New York plan, because it actually has the lowest plan fees and the lowest expense mutual funds available.
Interesting.
Yeah.
So you don't have to live in the state to use that state's fund?
No, but that's the thing of Missouri, which is really nice. So my contributions to that plan are Missouri state deductible, tax deductible. But like if I lived in Illinois, I would have to use the Illinois Bright plan to be able to get the tax deduction there. But so those funds go for your child's education. When you withdraw them, they're tax-free. They can be used for books, for college education, for like actual like tuition expenses, stuff like that. So
that's good to know.
That stuff's really important and helps, plan for your kids long term. So like the day my daughter was born, as soon as I got her Social Security number, I opened an account for her and started funding that.
Great. And that's 18 years. You can grow a fund pretty large in 18 years with fairly minimal contributions, I'd argue.
Yep. And then using that tax free is to pay for college is super amazing.
Yeah. Awesome. Anything else I'm missing?
I don't think so.
Okay, great. I may have to bring you back on again just so we can dig into more stuff.
I would love it.
Oh, good. I'm glad this wasn't that bad. I'm glad you're game, because there's a lot here, and I think it's super important, and it's confusing, and there's a lot of sharks out there. So I'm glad you could come in and help and provide clarity. All right, Jeff, thank you for your time. You're the man. What's the name of that podcast you're starting to help Christian men with finance? What's it called?
I don't have it yet.
You don't have it yet. Oh, okay. Well,
Oh,
how about when you start it, I'll bring you back on here to promote it a little bit. And we
that
can
sounds like a good idea.
get
I
you some
like that.
posts. All right, dude. Thanks. This is awesome. I appreciate it.
Thanks, John. I appreciate it.
All right.